Over the past year, Warren Buffett has sold over 615 million shares of Apple stock and reduced his stake in Apple by almost $87 billion. So, why did he sell and what does it mean for you? Let's dive in and find out. In this video, I will cover why Warren Buffett is selling Apple stock, what I think about Apple stock and its value, what Wall Street smart money says, and what you should do based on that information. So, as I mentioned, over the past year, Warren Buffett has sold over 615 million shares of Apple stock and reduced his stake in Apple by almost $87 billion. But don't be alarmed, Buffett still owns 300 million shares of Apple, and it makes up over 26% of his overall holdings.
It's the smart move.
He wanted to reduce his exposure over time gradually because he continues to believe in the company long term. A year ago, Apple was 50% of his overall holdings, with the value of his stake at almost $157 billion. From a portfolio management perspective, a position size of 10% or more is considered a concentrated and large position. The valuation for Apple is significantly above its historical averages. Over the last 5 years, Apple's average price to earnings multiple was around 29 times. Today, it's nearly 40 times, signaling that the stock price may be a bit ahead of its valuation. Buffett is up nearly 10x since he originally took his stake in Apple back in 2016, and he's made nearly $100 billion in profit. As an investor, Warren Buffett is a long-term holder, but he's always on the lookout for the next great opportunity.
He's a professional.
He's looking to reallocate his winnings from Apple to other undervalued names, but he still very much believes in the company. When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
I don't think so.
That is exactly what you're doing when you buy a stock without understanding the three financial statements. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases and we win. Apple has almost $30 billion of cash, and if we combine the cash invested in securities, it is over $156 billion. This gives the company tons of money to invest in the future, whether it is AI or the next amazing iPhone. The company has a little bit more than $106 billion in debt, but it has been declining since COVID. Apple is net cash, which means cash is greater than debt by about $50 billion. And the average cost of debt is only 3.4%, so it's not expensive. Retained earnings is declining, which is normally a red flag, but it is not because the company is losing money. It is actually because Apple is returning so much capital to shareholders via dividends and share repurchases. So what's the takeaway? Apple has tons of cash, its debt is manageable, and it is returning billions of dollars to shareholders. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profits is via margin. Revenues minus expenses equals income, and then income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Last year, Apple generated a staggering $391 billion in revenue, with nearly 25% coming from services, such as iCloud, Apple Care, Apple Pay, and the App Store. Overall, revenue growth was only 2% because Apple's business in China suffered a decline of almost 8%. Margins expanded across the board, which is a tremendous positive, showing operating efficiency with the exception of net margin. This is due to a one-time tax in Ireland of over $10 billion from a dispute which had been unresolved since 2016. Apple has averaged over $90 billion in net profits over the last 4 years, after averaging only $55 billion the previous 4 years. Being able to pass on more of its costs means more money flows to the bottom line, which is great for investors. So what's the takeaway? Despite softness in China, Apple is still going strong, expanding margins and increasing profits for investors. The cash flow statement tells us where the cash is generated by the company, and there's 3 buckets. Operating is the cash the company generates internally, investing is the cash demanded for long-term growth, and financing is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating positive cash rather than losing cash, which would make it negative.
Well, it makes sense to me. What do you think, Bob?
Operating cash flow is positive and growing rapidly. The operating cash flow is primarily driven by the strong net income that Apple is generating. Investing cash flow is positive, which is rare, though a silver lining. While long term investment in the business or CapEx usually results in negative investing cash flow, Apple is generating tens of billions from the over $126 billion of cash that it has invested in marketable securities. Financing cash flow is negative, but it's not primarily due to paying down debt. What is fascinating is that the bulk of the outflow is due to the massive amount of cash that is being returned to shareholders via dividends and share repurchases, which amounted to over $110 billion in 2024 and has averaged almost $100 billion annually over the last 5 years. So what's the takeaway? With over $150 billion in cash and cash equivalents, Apple is using those assets to generate income, which it is returning to shareholders and reinvesting in the business for the long term. Do you want to build wealth and have a proven system to pick winners and avoid losers?
No, that's not all. I want to be rich.
Investing success requires discipline, the skill of investment analysis, and the techniques that are proven. Some of the world's largest asset managers and investment banks pay me thousands of dollars a day to train their analysts. But what if you could have access to that knowledge for just a fraction of the cost?
Sounds good to me.
That is exactly why I created the Win Like Wall Street community, to give regular folks like you and me the tools and cutting edge strategies to build wealth consistently and predictably. Don't wait. Right now, go to bit.ly/WLWS to join my exclusive community, Win Like Wall Street, where you can get the same Wall Street knowledge as the world's largest financial services firms, my Excel models, and direct access to me. See you on the inside. So am I selling Apple like Warren Buffett? I'll get into that. Let's go through the valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the three financial statements, we can take these future cash flows, discount them back to today to get an intrinsic value of the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above, and it's in the description. As you can see on the left, we take specific line items that we projected from the three financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we need to strip out debt and cash. We then divide that by the shares outstanding. We get an implied share price of about $190 per share. Compared to the current share price of $222, that is a 17% premium, which is a sell rating. Now, this does not mean that I am personally selling Apple, and I'll explain why not later on.
Okay, I'll wait in my office.
So, what does Wall Street have to say about Apple? Recent analyst opinions on Apple have varied, reflecting differing perspectives on the company's performance and future prospects.
Dave, I'm an analyst.
Yesterday, Jefferies downgraded Apple from hold to underperform, citing weak iPhone sales, particularly in China, and a lackluster rollout of AI features under Apple Intelligence.
Now, Apple faces mounting pressure as Jefferies downgraded the tech giant to underperform, citing concerns over revenue growth following President Donald Trump's remarks about potential new U.S. investments from the company.
The firm anticipates Apple will miss its fiscal first quarter revenue estimates and guidance next week. Loop Capital lowered its rating from buy to hold, highlighting signs of materially softening iPhone demand. The analyst noted that generative AI features have not boosted iPhone 16 sales as expected. While maintaining an overweight rating, JP Morgan reduced its price target due to concerns about smartphone market share loss in China, limited traction for AI features, and foreign exchange headwinds. All right, so this is a screen share of Capital IQ. I use this a ton. 41 analysts cover Apple on Wall Street, which is a lot. The target price ranges from a low of 183, which is an 18% decline from the current close, to a high of 325, which is a 46% increase from the current close. The median is 250, which is about a 12% increase from where the stock is currently at. Now, the overall rating on a scale of 1 to 5 is 1.96, which is an outperform rating. Now, you should seek the advice of an investment professional always. I do not know your individual financial situation, and this content is meant to educate and is not investment advice. That being said, I do have a position in Apple, and despite a sell rating in our model, I am not selling, and here's why. Apple is only 2.8% of my portfolio, so it's not a huge position. If it was above 5%, I would probably pare it back and take some gains. Like Warren Buffett, I believe in Apple. I'm an avid iPhone user, and Apple will be leading the charge in an AI world. I am concerned about softness in China, and I want to see what happens there and how the company addresses it. China is 17% of revenues, down from 19% in 2023, and I want to see recovery there. For the last 40 years, Apple has proven to be one of the greatest innovators in the tech space and has a rock solid set of financials. Margins are expanding, the company is net cash by $50 billion and returning tons of cash to shareholders while investing in the future. Apple hit an all-time high of 260 about a month ago, and it's down over 14% since then. Apple reports their 1Q25 results next week on January 30th, after the market close, so there will probably be movement in the stock. Apple's move into AI via Apple Intelligence is very exciting, and it's using generative AI to give us the ability to write, communicate, and search with its many devices, and I'm excited to see it all come to fruition. The stock becomes much more interesting under $200, and if it went down to 180 or so, I would consider increasing my position. If you like this and want to see another in-depth stock valuation, check out my Rivian video here or my Starbucks video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.